The weather vanes are shifting, and the economic indicators we have long relied upon are swiveling as well. As the Federal Reserve prepares to make its next fateful move on interest rates, all eyes are trained on one number above all others, the monthly employment report. We find ourselves in an economic season of upheaval and transition. The raging wildfire of inflation that scorched the land just months ago is at last being tamed by the Federal Reserve's dousing of icy interest rate hikes. But the collateral damage is now coming into view. A labor market gone dry and brittle, businesses retrenching, workers cast aside. The mighty economic engine that powered the recovery from the COVID abyss is coughing and sputtering. In such an unsettled climate, the employment data has emerged as the North Star by which the Fed will chart its course on monetary policy. Inflation readings, once studied with monkish devotion, have been overshadowed by the portents in the jobs numbers. For it is the strength and resilience of the labor force that will determine whether we can navigate these choppy economic seas without capsizing into a recession. The Fed's philosophical shift reflects the cold reality that the central bank has more leverage over employment than inflation in the short run. By ratcheting up borrowing costs, the monetary mavens can deliberately apply the brakes to hiring and wage growth. But their influence over the price levels that stoked the inflationary blaze is more indirect and slow-acting. The hope is that by slowing the employment juggernaut, they can moderate consumer spending enough to allow supply to catch up with demand and cool off those searing price pressures. So Jerome Powell and his cohort at the Fed have acknowledged that risks to the labor market now outweigh their traditional focus on inflation vigilance. And on Wall Street, investment battalions have redeployed their analytical arsenals accordingly. For the first time in 2 years, employment releases are moving markets more than inflation reports. The whiplash response to the July jobs data, when a higher unemployment rate triggered legitimate recession fears and a $6.4 trillion global sell-off, serves as a wake-up call. If now you put a lot more weight on every single payroll report, then you could get back to an extremely volatile environment, laments Gregory Dacko of EY. Unfortunately, many economists, many Wall Street investors tend to mark to market, and they tend to react emotionally. This mercurial new reality reflects the profound uncertainties buffeting the economy. Having conquered the stagflationary devil of high inflation and stagnation, we now must stringently monitor for excesses in the other direction. If the Fed's anti-inflation zeal leads it to over-tighten and send the labor market into a harsh downturn, it could upend the livelihoods of millions and squander the hard-won employment gains of the past 2 years. The unnerving volatility is compounded by the conflicting signals the economy has been sending. GDP has contracted for 2 straight quarters, but the labor market has remained sturdy, with low unemployment and over 1 million jobs added over the past 3 months alone. I'm reminded of that old metaphysical saw about the tree falling in the forest. Does a recession count if the jobs market doesn't creak? And for all the gloomy prognostications about consumer spending being crushed under the weight of high prices and interest rates, the economy's main engine continues to hum. Sure, savings have been depleted, real disposable income is down, and credit card debt has swelled. But retail sales have been surprisingly resilient, suggesting the vaunted American consumer remains doggedly confident. So in our current state of bafflement, eyes fittingly are laser-focused on any tremors in the employment numbers. This laser-like vigil reflects the new emotional resonance that job concerns carry in the economic discourse. Once an esoteric data geyser studied only by propellerhead economists, the employment report now looms as large in the public psyche as the iconic misery index of the 1970s. It reflects real-world fears about maintaining middle-class status, keeping businesses afloat, and planning for retirement. Pollsters detect a palpable drift toward economic anxiety, with a growing share of consumers fretting that jobs have become harder to get. Political forecasters also see the potency of the issue. Incumbent parties unable to keep kitchen table economics placid face the wrath of voters. And Republicans have been quick to seize on any labor market wobbles during the Biden years. Donald Trump and his surrogates have sought to saddle Vice President Harris with responsibility for recent job losses, hoping employment jitters could corrode her standing. To her credit, Ms. Harris has trained her initial economic messaging on inflation relief and middle-class aid, recognizing that paychecks are being shredded by the vortex of rising prices and interest rates. In a recent CNN interview, she called addressing economic pains her day-one priority, without diving too deeply into her specific remedies. Everyone experiences high inflation, and it will be a smaller subset who experience unemployment. notes Veronica Clark of Citigroup. But people would be worried about it, even if you don't lose your job, and that's where it almost feels a little bit worse. For now, the political footballing of the issue awaits definitive kicks from the monthly employment stats themselves. Forecasters generally expect the August data to show a jobs rebound, with employment gains over 200,000 and a dip in the unemployment rate. That could provide some stabilizing comfort ahead of the Fed's upcoming decision on September 20th to 21st. But even a relatively strong report may not dissuade the central bank from an aggressive half-point rate hike. Remember, Powell has underscored that the Fed must remain data-dependent rather than locked into a preset course. And the committee is likely to see an inoculating large hike as prudent preventative medicine against potential labor market fever ahead. In the Eccles building corridors, there's little doubt the committee has pivoted fully into inflation fighter mode. As tough-talking Fed leaders remind us, their credibility in anchoring price stability expectations hangs in the balance. Another jumbo 75 basis point rate increase cannot be ruled out if the jobs data revives recession fears, especially with midterm elections looming. For while the near-term employment picture remains vital, the Fed must play a longer game to navigate between the Scylla of excessive inflation and the Charybdis of an employment crash. Ideally, it can engineer a so-called immaculate disinflation, moderating price pressures with only a modest labor market softening and no major economic downturn. But Fed governors fret whistling past the employment graveyard invites comparisons to the hapless captains who assured us inflation is transitory. And so the jobs data has taken on an almost mystical significance in our current season of economic angst and uncertainty. Like latter-day soothsayers, each monthly release of the non-farm payrolls and unemployment rate is pored over for signs and portents. A buoyant number could embolden the Fed to stay borderline hawkish in squelching inflation, while a dismal reading could encourage erring toward dovishness to avoid hammering hiring. In this hazy economic climate, we must acknowledge our limited visibility and humble ourselves before the great mystery of labor market dynamics. For the employment data has become less a simple set of backward-looking indicators than an augur of which path the economy travels next. The old guideposts of yield curves and leading indexes have been buffeted aside by the blunt force of these mercurial monthly hiring tallies. We'd be wise to absorb the insight of 19th century author John Ruskin, who recognized the sacred nature of employment, writing that in order that people may be happy in their work, these three things are needed. They must be fit for it. They must not do too much of it. And they must have a sense of success in it. As we careen through this latest economic tempest, that sense of success is exactly what hangs in the balance for millions of workers and their families. Can the Fed normally guide us to calmer shores without seeing mass layoffs rob the dignity and purpose that productive employment provides? The fates of so many now appear inextricably linked to those few frenzied hours once each month when the latest jobs numbers are digested and divined. So give the monthly hiring reports their due. They are no mere data morsels but the breadcrumbs scattered along the twisted path by which we might navigate our way through this latest economic thicket. Like it or not, they have become the burning bush pointing the way through this economic wilderness, a truth that cannot be ignored by policymakers, market participants, or workers alike. For those in the trenches of the labor force, the jobs report carries a resonance that transcends its dry data points. It shapes the fundamental outlook on career prospects, financial stability, and the ability to build the middle-class lives we expect in America. Take the case of Ashley Turner in Houston. After being laid off from her marketing job a year ago, she has applied for nearly 200 positions without success. Despite expanding her search beyond her field, the 32-year-old has landed only a handful of interviews. Increasingly desperate, she now considers contractor roles or entrepreneurship. It just seems like there's some disconnect within the last year that's just not adding up. She laments of the opportunities available. For Ms. Turner and millions like her, the monthly jobs report carries almost existential weight. Their gnawing concerns are validated by the souring consumer sentiment data. Americans are rapidly losing faith that jobs remain readily available. A University of Michigan survey last week showed the share of respondents viewing jobs as hard to get at the highest since early 2021, an ominous signal that the robust labor market could be curdling. And perhaps most disconcertingly, these employment anxieties appear to be solidifying across generational lines. While the young have faced a barrage of disruptions from academic upheaval during COVID to the bursting of hot employment sectors, a 2008 recession rerun looms for older cohorts. The last time we had this type of economy with rising rates and high inflation was back during the Great Recession, which was horrible for everyone but millennials were just coming into the workforce," said Liz Young, head of investment strategy at SoFi. "Now the roles are reversed, and the millennials are in their prime earning years and aren't eager to relive 2008. Indeed, this great white-collar recession could make the recoveries of recent decades look tame. Previous downturns were concentrated in sectors like manufacturing, real estate, and finance, painful to be sure, but without the same widespread dislocation a services-driven recession might produce. A white-collar recession where technology companies and business services start shedding jobs. That's the type of economic backdrop we haven't really experienced," Young said. "And it is precisely this spreading employment contagion that the Fed now frets over. By the central bank's calculations, the economy likely needs to shed somewhere between 1 million and 1.5 million jobs to rebalance labor demand with supply and ease wage pressures threatening a 1970s-style wage price spiral. But executing such a immaculate disinflation without crashing the entire job market is a daunting high-wire act. Already the layoffs have come from many corporate workforce brigades, from West Coast tech behemoths to Wall Street trading desks and mortgage lenders on Main Street. Tens of thousands of jobs have been erased in recent months at Meta, Twitter, Tesla, Netflix, and Robinhood. Even stalwart companies like Walmart are joining in the staff slashing. The reasoning is clear enough. With the Fed admitting its determination to restrict demand by diminishing job openings, businesses must proactively downsize before profits evaporate. And capital expenditures are equally vulnerable. The clouds of economic uncertainty have caused a sharp 8% pullback in spending plans, presaging more labor cutbacks ahead. Will the retrenchment remain contained to these vanguard leading sectors? Or will it metastasize into a broader employment route that extends through the nationwide office parks, malls, restaurants, and small businesses that collectively fuel the bulk of the labor market? If the latter nightmare scenario unfolds, the Fed may be forced to tap the brakes earlier than planned to avoid crushing the very engine it is merely trying to cool. There is clearly a tension between the Fed's stated philosophy of data dependence on the current economic readings and its overriding mission to reestablish its credibility as an ironclad inflation fighter. Policymakers at the central bank are doubtless aware of the excruciating trade-off they face. Driving the economy into a ditch to extinguish inflation would grievously undermine the employment strides achieved since the pandemic, and would render the price stability etched on their mandate utterly meaningless to displaced workers. But on the other hand, tolerating even a small reignition of the inflationary bonfire would mark an embarrassing abdication of the Fed's core responsibilities. Institutional self-preservation tugs them toward allowing the job market to weaken, if needed to definitively snuff out price pressures.